Hello everyone out there. Welcome to our YouTube channel Finbuzz Learning. Here we are again back with a popular topic that you guys might be knowing. Today we will going to discuss equity shares in detail. Let's get started by understanding the equity shares. So, the amount that a company's owners have put into their enterprise is known as shareholders' equity. This covers the funds they have personally invested as well as the total amount of earnings that have been reinvested by the business since its beginning. A firm dilutes its ownership by issuing equity shares in order to raise finance. To acquire partial ownership of the company, investors might purchase equity share units. Investors will become shareholders in the company and contribute to its total capital by purchasing equity shares. Now, let's discuss the characteristics of equity shares. So, the first feature is permanent shares. So, equity shares are inherently enduring. Shares are a company's long-term assets and only get returned when the business shuts down. So, the next characteristic is significant returns. So, equity shares have the potential to generate significant returns for shareholders. However, these are risky investment options. In other words, equity shares are highly volatile. The price movements can be drastic and are dependent on multiple internal and external factors. Therefore, investors should only think about investing in these if they have a reasonable level of risk tolerance. Now, the next feature is dividends. Well, equity investors split a company's profit. In other words, a business can use its yearly profits to pay dividends to its shareholders. However, a firm is not required to pay dividends. A corporation can decide not to pay dividends to its shareholders if it doesn't generate enough cash flow or earn good profits. The next feature of equity share is voting rights. So, the majority of equity shareholders have voting privileges. This enables them to decide who will run the business. Selecting capable managers help the business increase its yearly turnover. Investors may therefore see an increase in their average dividend income. The next feature is additional profit. Well, shareholders of an equity corporation are entitled to an additional profits. In consequences, it raises the investor's net worth. The next feature is liquidity. So, investments in equity shares are quite liquid. The shares are traded on the stock exchanges. The share is therefore available for purchase and sale at any movement during trading hours. Consequently, one need not be concerned about selling their stock. Now, the last feature is limited liability. So, the common stockholders are unaffected by a company's losses. In other words, the shareholders are not responsible for the debt obligations of the business. The price of equities is down, and that's the only effect. The return on investment for a shareholder will be impacted by this. Now, coming to the next topic is the types of equity shares. So, the first type of equity share is ordinary shares. These shares are issued by an organization to raise money to pay for long-term costs incurred by a business. An investor receives ownership benefits as a result of them and is exposed to numerous management areas that are involved in running businesses. An individual possessing a large number of these types of equity shares has substantial voting rights. Now, the next type is preference equity shares. Prior to returns being divided among regular shareholders, preference equity shares are typically issued to investors as a guarantee of the payment of cumulative dividends. However, unlike common shares, preference shares do not come with the same voting and membership rights. The next type is bonus share. These kinds of equity shares are issued from a company's retained earnings, which are then divided among investors as a new ownership interest in the business. Bonus shares, in contrast to other forms of equity instruments, do not raise a company's total market capitalization value. It simply shows the capitalization of extra money made from production. Now, the next type is right shares. So, these shares are offered at a discount by a firm to premium investors as an encouragement to enhance their ownership in the relevant business. A company only sells shares to rights for a predetermined period of time in order to raise the money needed to cover its expenses. Now, there arises a few questions. Why should you invest in equity shares? So, there are various benefits of equity shares that we will discuss one by one. The first benefit is high income. So, the equity share market is an ideal segment of the capital market responsible for the remarkable income of investors. In addition to the capital growth of these instruments, substantial dividend earnings earned by an individuals also contribute to wealth accumulation. The next benefit is hedge against investment. So, investment is profitable stock shares raises people's standards of living through appreciation in asset value. Equity investments offer multiple returns that are greater than the rate at which inflation is eroding people's purchasing power. As a result, investments usually have an increasing real worth over time. The next benefit is portfolio investment. Well, debt instruments are more stable for investors that have a low tolerance for risk. However, when it comes to aggregate demand, changes in the stock and bond markets are inversely associated. Therefore, risk-averse investors can earn from investments in the best equity shares through stock market investments when the bond market is underperforming. Now, what are the risks associated with these investments? The equity share market typically has the highest volatility and is the most affected by even the smallest changes. Returns on equity investments are paid out once a business has fulfilled all other obligations. When the market is weak, a company's production cycle is impacted, which reduces profits generated by a business. Before money is distributed as returns on equity investments, the lesser portion of earnings is used to pay off all outstanding obligations. Therefore, equity markets typically suffer during a market downturn. Well, market fluctuations are a natural aspect of the business cycle, which includes peaks and troughs depending on the socio-economic conditions of a given nation. Even if stock shares show lower returns at one point in time, they will inevitably increase as the economy starts to recover. Equity investments also frequently increase in value over time. Therefore, if funds are maintained locked in for a long time, their value is likely to expand significantly in the future, assuring that investors will significantly enhance their wealth through capital gains. So this was all about the equity shares. Hope you guys now get the topic properly. Do like, subscribe and share the channel. Thank you for watching and have a wonderful day.